Ever wondered how non-current assets held for sale and discontinued operations are accounted for? Well, that's where IFRS 5 steps in. This crucial standard provides clear guidelines on how to classify, measure, and present these assets, ensuring transparency and comparability in financial reporting, especially for businesses undergoing significant structural changes. It is a beacon of clarity in the complex world of accounting standards. Now that we know why IFRS 5 is important, let's delve into what it entails. What exactly are non-current assets held for sale? Well, according to the International Financial Reporting Standard 5, or IFRS 5, these are assets whose carrying amount will be recovered through a sale transaction rather than through continuing use. They're ready and available for immediate sale in their present condition, and there's a committed plan to sell them. Measurement of these assets is crucial. Once an asset is tagged as held for sale, it's measured at the lower of its carrying amount and its fair value less costs to sell. This ensures that the asset isn't carried on the balance sheet at an amount higher than what it can be sold for. And how are these assets presented in the financial statements? IFRS 5 mandates that they be separated from other assets. This allows for a clearer view of the company's financial position. With a clear understanding of non-current assets held for sale, we can now move on to discontinued operations. What qualifies as a discontinued operation under IFRS 5, you might ask? Well, a discontinued operation is defined as a component of an entity either already disposed of or classified as held for sale. Now, when we talk about the results from these operations, they need to be presented separately in the income statement. This is crucial, as it allows users to clearly distinguish between the financial performance of the ongoing and the discontinued operations. Think of it like neatly partitioning a room. It helps to keep things clear and organized. But what if there's still some level of involvement with the discontinued operation? Well, under IFRS 5, any continuing involvement with the discontinued operation also needs to be disclosed. This ensures that there's a complete transparency about the entity's activities. Now that we've covered the basic principles, let's discuss the practical considerations of IFRS 5. How does IFRS 5 apply in practice? This is a question that often pops up. As we've learned, the criteria for classifying assets as held for sale and identifying discontinued operations are stringent. It's not a simple tick-box exercise. It requires a meticulous examination of the facts and circumstances surrounding the asset or operation. For instance, when assessing whether an asset is available for immediate sale in its present condition, accountants should consider a variety of factors, such as the current state of the asset, the market conditions, and any regulatory approvals needed for the sale. This often requires collaboration with other departments within the organization, such as legal, sales, and operations. Similarly, identifying discontinued operations is not always straightforward. It's not just about whether an operation has been disposed of or is classified as held for sale. The accountant must also determine whether the operation represents a separate major line of business or geographical area of operations. This requires a deep understanding of the organization's structure and operations. Finally, the disclosure requirements of IFRS 5 are extensive. They necessitate a thorough review of the financial performance and cash flows of the discontinued operations, as well as any continuing involvement with these operations. This level of detail is critical in ensuring transparency and comparability in financial reporting. And there we have it, a comprehensive overview of IFRS 5, a key standard for accountants in ensuring transparency and comparability in financial reporting.